Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Wednesday, January 25th, and we've got Gerard Minack from Minack Advisors here to give us an update on his forecast for 2023. Gerard, thanks for joining us, and welcome.
Happy New Year, Ken. Yeah, great to be here. It is the future here, of course. It's the 26th already, but I'll let you know the market close at the end of the show.
That's great. You had some great calls last year. I think we met at the beginning of last year, one of which was that the 10-year would get up to 4%, which at that time I think was a pretty out of consensus call. You also had some great thoughts on some long-term forces that would drive growth and inflation higher, things like deglobalization, decarbonization, which I'd love to hear about later as well, your thoughts on how that has developed. But I guess the big thing on everyone's mind is, are we in a recession? Is inflation coming down back to 2? And who's right, the Fed or the bond market? Because the bond market sure doesn't believe the Fed's going to take us to 5 and stay there. So I know you usually lay out a nice path for us. So I'll just turn it over to you to give us your thoughts.
Yeah, thanks, Ken. This year certainly started with a bang, and in a way, the everything bubble is back. After last year, a year when all the major asset classes fell, we've started with a strong year. And I'm very much of the view that we can't have both the rate market being right in what it's forecasting and the equity market being right in what it's forecasting. One of them is going to be wrong. Potentially both of them are going to be wrong. And I'm concerned that the Goldilocks view that's starting to become priced into equity markets is going to be proven or spoilt later this year. There is some uncertainty about how it's going to be spoilt. My base case is that we do get a recession that starts probably June quarter. If we get a June quarter recession, then the rate market's probably right to be expecting Fed easing in the second half of the year. But the equity market's dead wrong in thinking it's going to be a painless recession and there's no earnings risk. And in that context, or that scenario, the equity market would be hit by, I think, quite severe earnings downgrades. But there is also a risk that the rate market is underestimating the resilience of the economy, and we're not going to get this immaculate disinflation that the market's now pricing. Let me show you what I mean by immaculate disinflation, which is really my shorthand for saying it's a painless move back to the Fed's inflation target. Now have a look at this chart here, which is showing actual CPI and the market's forecast for inflation as taken from the inflation swaps. So the market's effectively expecting a very fast return to 2% CPI, which would be a terrific outcome from the Fed's perspective. Now, I think this is probably too optimistic. It's optimistic either because inflation won't stay at 2 unless the Fed gets the labour market under control. And it's particularly too optimistic if you think the Fed can achieve this painlessly. And the reason is we've got to look under the hood at the CPI data. And particularly if you look at the core CPI, in this chart here, it's got a breakdown of its components. The bulk of core CPI is driven by shelter and services. And even if goods inflation went to 0 tomorrow, core CPI would still be running at 5%, which is clearly unacceptable from a Fed perspective. Now, the two big components are shelter and services. And shelter inflation may be starting to slow. Certainly, more up-to-date measures of rent are saying that rental inflation is likely to slow. It's too early to say it's going to go back to levels that the Fed would find comfortable, but we probably are close to passing a peak. But the single biggest issue from a Fed perspective is this chart here, which is showing core service inflation and labour costs. And the key point is service sector inflation is driven by wages. And wage growth at the moment, which on this measure, which is the employment cost index measure, is a little over 5%, is incompatible with the Fed hitting its inflation target over the medium term. If the Fed is going to get wage growth down to a level compatible with its inflation target, it will need to loosen the labour market. The big question is, how much looser does it need to make the labour market? Well, the relationship between wages and unemployment, unfortunately, isn't stable. And this chart, unemployment and wage growth, which shows that relationship, highlights that it's moved out. It's moved from the purple line to the red line. In other words, the trade-off has deteriorated. If the red line accurately represents the current trade-off between unemployment, which you read on the horizontal axis, and wage growth, which you read on the vertical axis, then the Fed probably needs to engineer a lift of unemployment by 1 to 2% to get wage growth down to a level compatible with its inflation target. Now, the Fed's own forecasts actually have an increase of over 1% in the unemployment rate over the coming year. But here's the punchline to this story. There's never been an increase in US unemployment of more than 0.5% without a recession. In other words, if you think this accurately captures the trade-off between wages and unemployment, and the task ahead of the Fed is to get the unemployment rate up by at least 1%, you need to make a recession your investment base case, unless you think this Fed can pull off something that no other Federal Reserve has ever achieved. And I'm not saying they're going to do that. So that's why I've got recession as my base case. But then there's the question of timing. Now, as I've already mentioned, I think June quarter is a plausible start date for the recession. And if we get a June quarter recession onset, the Fed will be easing in the second half of the year. But there are real risks around that. And I think a little like 12 months ago, where the risk was that the economy was going to prove to be more resilient than the consensus was expecting, that again is the risk we face this year. And that would imply that the peak in rates is higher than what the rate market is now expecting, or we have to stay with high rates for longer than the market's expecting. Under either one of those scenarios, the pressure on 10-year yields will almost certainly be up, because we won't get the fast pivot that seems to be behind the current rally in duration. Now, why should the economy yet again be more resilient than what the Fed is expecting? Well, this is the irony of the likely decline in inflation, even if that decline is due to transitory factors. What it's going to do is restore purchasing power, real purchasing power, to the average American consumer. This chart shows aggregate household labor income in the US. Now, just to be clear what this is not wage growth. This is hourly earnings times number of hours worked times the number of people working. So it's the total wage bill being paid by corporates to households in America. And I always think of this as core income, because the average American doesn't receive dividend checks, doesn't get interest payments. Wage and salaries are their bread and butter. Now, in this chart, I'm showing you quarterly data. Over the 4 quarters to September, aggregate labour income was up by 8%. But because we had quite high inflation, that translated into real aggregate labour income growth of just 1%, which is why American consumers this year, to sustain their spending, last year, 2022, had to draw down on saving. But let's just assume that those inflation swap forecasts are right, and by the second half of the year, inflation is running at just 2%. If nominal labour income is still running at 8%, that means real labour income will be back at 6%. Now, the reality is the nominal income may probably slow a little bit, but if it slows to 6% and you've got 2% inflation, even on a transitory basis, that will give you 4% real aggregate labour income, and that's more than enough to keep real consumer spending, which is 70% of GDP, at quite a warm level, and more to the point, keep the labour market at a red-hot level. So this is the big risk, in my view, that the economy stays stronger for longer, which means rates stay higher for longer than what the market's now pricing. So it's an irony that the prospective decline in inflation, which is after all what the Fed's after, is going to prop up real consumer spending in a way that's ultimately detrimental to the Fed keeping inflation down as it looks into 2024. So the bottom line for me is the Goldilocks mix that markets are now pricing, I think, is the impossible dream. And what I'm trying to work out is the most likely way that dream is going to spoil. My base case is that we have growth weakening enough that the Fed can cut in the second half of the year, but that would absolutely be to the detriment of the equity market. But there is also a risk that if growth stays stronger for longer, then we're going to get a sell-off in bonds and long-end yields going back above 4%. So I expect that something's going to go wrong in terms of the Goldilocks scenario in the next 2 or 3 months.
So if we do see growth start to roll over, earnings roll over, from where long-end treasury yields are today, do you think they're going to provide protection to portfolios? As they did not clearly last year, but with inflation coming down, perhaps the correlation of stocks and bonds will once again flip towards that negative correlation that we were used to over the last 20 plus years.
Absolutely right, Ken. It's worth just highlighting how incredibly unusual last year was for a high-level asset allocator. In fact, last year, we truly could say this time was different. Look at this chart, which is looking at S&P 500 and 10-year bond returns. I'm focusing on the returns through equity corrections and equity bear markets. So a correction is when the S&P 500 has fallen by 10%, a bear market is 20% plus. And this chart's going back to 1900. So it's 120 years worth of data. Now, those wriggly little red lines there, if you squint, that's the total return on owning a 10-year treasury through those equity corrections and equity bear markets. Last year was the first year ever, the first year in 120 years, when you lost money owning a 10-year bond in a S&P 500 correction or bear market. Now, that's a startlingly rare event, and it meant that the most obvious no-brainer, and I'm putting that in air quotes, no-brainer asset allocation shift that has worked every time for 120 years. When you see Wall Street falling, you buy bonds, blew up in your face last year, and blew up quite spectacularly. In fact, if you look at the performance of the long bond index, and this chart here compares the drawdown in the Bloomberg Long Bond Index to the drawdown in the S&P 500. The Bloomberg Long Bond Index had a 40% plus peak to trough decline, which was a bigger loss than the NASDAQ. In other words, shifting into bonds from equities was jumping out of the frying pan into the fire. But that is so exceptional, and it really reflected a couple of things. The first was obviously the all-time low starting point for yields. The 10-year treasury got down to 50 basis points. I mean, if you want to compare that to equities, that's the bond market being on a PE of 200 times. Now, buying a bond at that valuation level, you're always on a hiding to nothing. And of course, what made that a particularly bad investment was that we had the biggest inflation shock in 4 decades. Well, both those major red flags for buying bonds back a couple of years ago are obviously shifting. Under this scenario of weakness, we do see inflation falling, not rising. And with bond yields starting at 4%, they had a much more attractive, not as attractive as we've seen 20, 30 years ago, but much more attractive than 2 years ago. So I'd be staggered if you didn't make money this year by being long duration if the recession scenario unfolds. Whereas I'd also be staggered if you didn't lose money owning equities. And just to try and quantify these, the magnitudes. For bonds, if in a recession we see the 10-year yield go from 4% to 2%, I think the duration on a 10-year is a bit over 8%. So roughly speaking, every 1% move down is a 8% capital gain. So a 2% move with a 4% starting yield is a 20% total return. And you'd make even more if you bought longer duration paper. Whereas the equity market, on the other hand, I think would very much likely fall 20 or 30%, even if we saw a so-called vanilla recession. Define a vanilla recession. In my mind, that's where GDP and employment fall 2 or 3%.
So what's your base case for the potential earnings decline? I think Goldman is the most upbeat these days, saying they're in the soft landing camp right now, right?
Yeah, look, in a soft landing camp, there would be some damage to earnings, but not severe. But a recession, trust me, a recession always hits earnings. And what's notable, and if you look at this chart here, which is looking at the drawdown in non-farm payrolls, which is just a way to calibrate the severity of a recession, and the drawdown in S&P 500 EPS from its peak, this starts going back to 1945. The standout point from this chart is that earnings have become more sensitive to macro drawdowns or economic recessions over the last 3 decades compared to the sensitivity prior to that. Now, why is corporate America more sensitive to economic weakness? Well, over the last 3 decades, corporate America has become increasingly financially levered and operationally levered to the cycle. Now, the benefit of that is when times are good, you maximize your EPS upside. The downside of that is when you hit a macro bump on the road, you take a much bigger economic and EPS hit. What this shows is, or suggests, that even in a vanilla downturn, I think you ought to expect a 20 to 30% peak to trough decline in S&P 500 EPS. And that's absolutely my base case if we have a recession. And I don't think that's in the price. Where we are today, forecast earnings for the S&P 500 are within 3 or 4% of all-time highs. In other words, when people tell me this is the most forecast economic recession of all time, my immediate response is to point out the sell side hasn't got the memo. Equity analysts are still saying that the drop in earnings will be quite trivial. And I think they're dead wrong if you do indeed get a recession. And it's worth remembering that these sell side forecasts are almost always wrong. Why do we watch them? Well, they've got the one benefit of being, in a sense, predictably wrong. The errors are very pro-cyclical. If you look at this chart, which is comparing the surprise to EPS forecasts and the manufacturing ISM just is a cycle indicator. The manufacturing ISM is the red line. That's on the right-hand vertical. In a recession, you would expect the manufacturing ISM to get down to around 40 to 45 on that right-hand vertical. If the correlation between the ISM and the EPS forecast error holds up, and there's no sign at all that it's breaking down, then if you look on the left-hand vertical, that would correspond to a 20 to 30% miss. In other words, if the manufacturing ISM goes to 40 to 45, history suggests that consensus EPS forecasts will be wrong by 20 to 30%. And I'm absolutely of the view that that is not in the price. So this is where this immaculate disinflation, the idea that markets now seem to be leaning towards that the Fed can get inflation back under control with almost no damage to the real economy and no damage to the earnings outlook, I think is a fantasy. The only question in my mind is how is that fantasy spoilt over the next 6 months?
It definitely seems like the data keeps getting weaker. Leading economic indicators came in super weak. The survey data is very weak, albeit off its lows. So it does seem like this base case should play out. Credit spreads have come in with the euphoria in the equity markets, a little more so in corporate credit than some of the more securitized product spaces that we traverse in. Do you have a view on credit into this cycle?
Yes, I think the credit market, like the equity market, is becoming too complacent. This slide here looks at default rates and the bank lending standards indicator from the Fed's Senior Loan Officer Survey, which is the red line in that slide, as a lead indicator on defaults. You can see over the last 20 or 30 years that that bank lending indicator, the red line, has done an absolutely superb job leading corporate defaults. What it's now suggesting is that we're going to get a default cycle of only moderate severity, so nothing as bad as what we saw in 2008, but still something like we saw initially in the pandemic. So difficult, but no disaster. But then compare it to what the market's actually pricing, and this chart here looks at actual default rates and high yield spreads. And where spreads are at the moment, which is the blue line, that's consistent with almost no pickup, no serious pickup in defaults, not even a level of defaults like we saw in 2020. So I absolutely believe that the risk for credit spreads is that they will widen. I'm not pointing to an 2008 type scenario, but I do think the narrowing in spreads that we've seen year to date, which has gone hand in hand with all the other rallies in risk assets, is a mistake and will ultimately be reversed, particularly if I'm right and we get a hard landing later this year. So too much complacency in credit markets, too much complacency in equity markets. Safe assets like treasuries, they're doing the right thing, but we need to see that recession. One thing I would just say about the recession risk, this whole pandemic downturn and the subsequent recovery had many, many unusual features to it. One of the most unusual features was obviously this amazing bifurcation in consumer spending. And this slide just splits real consumer spending into three pieces: goods or durable goods, non-durable goods, and services. And look at that amazing wedge between goods and services through the pandemic. I mean, we know why that occurred. We got sent stimulus checks, but we weren't allowed to go out and dine at restaurants, so we all went online. And last year was payback. So we saw consumer spending swinging from goods back to services. Now, what's interesting about that is if you spend $1 less on goods and $1 more on services, that's GDP neutral. But it's absolutely not labour market neutral, because services are far more labour intense than goods. And it's that swinging from goods to services that really explains at a high level what we saw in the US last year. We got relatively anemic GDP numbers, and if you literally believe the data, 2 back-to-back quarterly falls in the first half. But we had a labour market that was steaming hot. So the key really from a Fed perspective is to loosen the labour market. And that's why we need to see service sector spending soften. And it's really a focus on service sector spending. The goods sector is already in some stage of distress. Manufacturing ISM is below 50. Inventories are reversing. Housing is declining. And this is where it gets interesting, because there are often delays here. And I think what we need to watch above all else in the first half of this year is not inflation data. I think the key to the Fed is labour market data. And so we've got to look at warning signs that the labour market's going to soften. There are some warning signs. Have a look at this chart, which compares the real level of construction spending, which is the red line, with the level of construction payrolls, the blue line. Spending on construction typically leads payrolls, but unsurprisingly, when spending on construction falls, you ultimately will always see job losses in the construction sector. And right now we seem to be where the gap is the biggest. construction sector payrolls are at cycle highs, even though we've seen 6 months of construction spending contraction. We are also seeing, clearly, job layoffs in the tech sector. So you're starting to get the first sign that we're on the cusp of a labour market turn. And if that gets validated by the figures in the current half year, then that absolutely is consistent with this June quarter recession call.
Yeah, I agree with you. I've been telling clients that this year is going to be all about jobs, and inflation is already coming down. So the Fed has already told us that they want to get that unemployment number up. I don't know. One of the things that's interesting is after Trump, we lowered immigration pretty drastically, and that has really hurt us, the people looking for jobs. Also, you have the demographic wave of the baby boomers rolling off the job market too. So a combination of those two things, along with people taking care of their relatives that have COVID and things like that, is kind of put us in this perfect storm, right, for the labor market being hot.
Absolutely. I mean, look, we all got used to discussing adverse supply shocks through the recession, and there was a focus on containers and shipping routes and blah, 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 blah. But I would argue that the single biggest adverse supply shock that we saw through the pandemic was actually the adverse supply shock in the US labour market. And if the labour participation rate today was back at its pre-pandemic level, there'd be an extra 2.5 million people in the US labour force. And it's that adverse supply shock that's worsened the trade-off between wage growth and the unemployment rate, which has put the Fed in its real jam. Now, some of this adverse supply shock you can attribute to some of the unique features of the pandemic, such as the widespread illness. But it's worth remembering that this is also part of a longer run demographic trend. This chart shows the US labour participation rate in red. The blue line is my estimate of how underlying demographic forces are moving it. And pre-pandemic, the actual participation rate, the red line, was a little above the blue line. It dropped precipitously, but it's regained only half that loss, and it's really stalled out at the blue line. In other words, we've bounced back to where the underlying demographic trends say we should be. So, the bull case for some people, the soft landing case for some people, is a situation where we do get a significant number of these people coming back into the workforce, and that eases the constraint on labour supply and makes the Fed's job easier in terms of loosening the labour market without necessarily causing broad-based job losses. Now, mathematically that's possible, but I think it's not very realistic, because I think we are now hitting the participation rate ceiling, and the ceiling's coming down because of demographic change. So I think that's why the Fed, in order to loosen the labour market sufficiently to get wages under control, will need to create job losses. And it's very hard for the Fed to just dial up the job losses just enough to get a recession. And to highlight how difficult that is, I mean, and the real problem is effectively, if you're watching the unemployment rate to drive your monetary policy, you really are driving the car by looking at the rearview mirror, because the unemployment rate is a lagging variable. But have a look at this chart, which is showing you, the blue line is showing you the increase in unemployment from its cycle low through periods of Fed tightening. And if you squint at the chart, you'll see a number of red circles. That's where the unemployment rate was in terms of its cycle low when the Fed last hiked in a cycle. And the green circles are when the Fed first eased in a cycle. Now, if you look at the last 30 or 40 years, all those green circles are very close to the horizontal axis. In other words, over the last 30 or 40 years, the Fed has pivoted from tightening to easing, with the unemployment rate typically only 0.2 or 0.3 above its cycle low. So the Fed has very quickly responded to the first hint of a rise in unemployment. But you know what? That was too late. It was too late to flip to easier policy with the unemployment rate 0.2 or 0.3 above its cycle low, because the underlying momentum in the economy had already turned so severely that the unemployment rate just kept on going up and you ended up in recession. So this is why it's so difficult for central banks to pull off a soft landing. There's only really in this time zone, and this chart goes back to 1955, 3 examples of a soft landing. The most recent was in 1995. But otherwise, once unemployment has risen by, well, as I said before, by more than 0.5 from its cycle low, every single time that's happened, you've seen a recession. And that's what makes the job of managing the economy so difficult, and why, if you are simply a betting man and you look at that chart, and that chart has got 13 Fed cycles, of which 10 of them ended in recession, there's your betting man's odds. More than 75% of the time the Fed is tightened, it ends up in recession. That's why you should normally default to assuming that the Fed's going to tighten too much and you end up with a hard landing.
Leon Cooperman was on CNBC the other day, and they were asking him about, what do you think about a soft landing? And his response was, "There's no such thing as a soft landing." And I think, so I think he would agree with you.
Right, because they had done it once or twice, but they've been very lucky, and of course they've never really pulled off a soft landing when they've been as far behind the curve as they have been in this cycle. In other words, they've let inflation get so far out of control before they started the tightening process. The soft landing stories, particularly 95, which I remember very well, inflation never really got to such a high level. The Fed was moving preemptively, aiming to slow growth, and therefore it could respond very quickly when leading indicators of growth started to moderate. This time, the data need to jump to get the Fed to pivot is a lot higher. The Fed can't just wait for something like the manufacturing ISM to roll over. That's already happened. It has rolled over. It's got to wait to see a material slowdown in the labour market, and it needs to wait for that because the real problem is now wage growth driving service sector inflation. And when you've got to that stage, when the inflation genie is out of the bottle, really there's been no examples where the Fed has been able to pull off a soft landing.
It's great insight, Gerard. One of the big winners last year that a lot of the macro funds were piling into was the dollar, and that seems to be reversing here. And if it does reverse, some international assets may do well. I saw you sent out a note this morning. I haven't had a chance to read it. I guess it's last night for you, about Japan. So the international markets have been off to a good start this year. They are a little bit more value oriented as well. So I just wanted to get your thoughts on the dollar and international assets.
Yes, look, I think in this next cycle, whenever it starts, and I don't think the cycle starts until we have the US recession. So I'm not saying that we've started the new cycle now, but I do think non-US assets will perform better than US assets. And there's a few reasons for that. One of them is just the valuation starting point. US equities in particular will significantly more expensive than the non-US equities. A second point is the prospective decline in the US dollar, and a falling dollar is always a bit of a tailwind for non-US assets. And I should say, whenever I am comparing US to non-US assets, I do that in common currency terms. There are several things that could weaken the dollar. One of them is a narrowing interest rate differential. But I think one of the least understood drivers of the dollar, particularly over the medium term, is America's terms of trade. Now, a country's terms of trade is the ratio of its export prices to import prices. So this chart here shows the US trade weighted index. So that's a basket of currencies. That's the red line, and America's terms of trade. So why did the dollar get so high last year? Well, America's terms of trade made a multi-decade high. But if you squint, you can see that the terms of trade have actually inflected. And what's going on there is America is a net commodity, a net energy exporter. So that reflects the pullback in energy prices. So if we get some softness there, then the dollar will likely fall. It will also be assisted down by the narrowing interest rate differential. So that's the second factor that would support non-US assets. The third factor really gets back to my bigger picture secular framework. And as we mentioned last time we chatted, I was a card-carrying secular stagnationist for 2 decades. Even before Larry Summers popularized the term, I was telling people I thought the world was turning Japanese. That is, we were heading into an era of low inflation, sluggish growth, and low rates. I've resigned from the club through the pandemic. I think the pandemic is the catalyst for a number of important shifts that means that we're going to leave the secular stagnation era. One of the most important elements of that secular shift is I'm very bullish on the outlook for CapEx, and not just any sort of CapEx. I'm not talking about more computer coders coming up with the next TikTok. I'm particularly bullish about the sort of CapEx that requires stuff, tangible stuff. And there are several drivers of this, and I'll be very quick, but I think we're seeing developed economies and the corporate sector aiming to shift the trade-off between efficiency and resilience. We spent 3 decades optimizing financial returns, but that ended up making systems that were very fragile. And the GFC really highlighted the fragility of the financial sector. I think the pandemic has highlighted the fragility of the non-financial sector. And recent geopolitical events have highlighted some of the geopolitical risks. So this is going to involve some onshoring of crucial industries, friendshoring of others, simply the supply diversification elsewhere, and as things as simple as shifting from just-in-time to just-in-case inventories. So that all is going to require some CapEx or higher inventory levels. The second factor pointing to higher CapEx is higher defence spending. Defence spending has been falling as a share of GDP throughout the developed world. That trend is going to change, sadly, but that's the reality. Third factor is spending on climate mitigation. This is potentially huge. The International Energy Agency thinks that the world probably needs to spend about $5 trillion per year to get to net zero by 2050. That's over 5% of global GDP. The fourth factor is more spending on public infrastructure. You're already seeing that in the US. One of the few areas of bipartisanship has been to increase public infrastructure. And finally, I think we're likely to see higher corporate CapEx as the attractiveness of labour replacing CapEx increases as wage growth increases. So all that points to higher CapEx structurally. That points to companies and sectors that make stuff doing better. And that plays to the hands of Europe, Japan, and parts of emerging markets. So really this structural shift in leadership in risk assets, particularly equities, reflects 3 things. The different valuation starting points, that non-US assets look cheaper. Secondly, a turn in the dollar. And thirdly, a shift in underlying macro leadership, where we are going to see a more CapEx-led cycle. And by CapEx in this context, I mean tangible CapEx, stuff. Blessed are the good makers, I think, for the next cycle.
So I got to believe, with the view of a weakening dollar and an increased CapEx, that also that you're Australian, that you're going to be bullish on commodities as well then, right?
It should be helpful, yes. I mean, I think the commodity mix may differ a little, what does better or worse in the next cycle than what we have seen, particularly in the cycle that ended at the GFC. But the bullishness on commodities is not just this demand side outlook for more CapEx. What's also very impressive, if you look at the supply side, is the discipline of commodity producers. Now, this chart here is looking at global investment in the basic resource sector. So this is really commodity producers ex the energy companies. The only reason I want to X the energy companies is I want to highlight that this is not just an ESG climate change phenomenon. So the red line is their CapEx as a share of global GDP. The blue line is their global return on assets. Now, historically, if you look back at the 60s, the 80s, sorry, 90s, noughties, you've got this rise and fall. As returns go up, that coincided with more CapEx. Then we saw the mother of all booms in 08, 09, with returns hitting all-time highs, and that led to the red line, the mother of all CapEx booms. Unfortunately for the producers, that led to a massive increase in capacity that came on stream just as the bottom fell out of the global growth cycle. The result was, if you look at that blue line, their ROAs went negative. In other words, the entire global sector started to lose money. Now, every CEO, CFO running one of these big companies today remembers that experience. So look at the difference where we are now. We have return on assets, the blue line, back at those all-time highs that we saw in 08, 09. So same great profitability. Now look at the CapEx line. We're a mile away from being at boom times. In net terms, so net of depreciation, there is zero global CapEx going on. Now, I'm not saying there'll be no CapEx expenditure at all going forward. That's not right. What I am saying is I think the supply side will be unusually disciplined. And that means from a producer perspective, returns are likely to be higher for longer in this cycle than we've seen in most historical cycles. So from an investment perspective, this looks a terrific story. On the one hand, you can see why demand will be relatively robust. On the other hand, we have an unusual degree of producer discipline. So that's quite a bullish setup for these industries over the medium term.
Yes, we've had a good run, and if growth slows, perhaps we'll see a rollover, but that could be a decent buying opportunity to get back in and get some
Absolutely
exposure.
right. And these things do look cheap, but yes, they are very cyclical. So, and this is why I've already made the point, this is a leadership story for the next cycle. We haven't yet started the clock on the next cycle, because if we've got a US recession, commodity prices probably would pull back. But I think the right medium-term attitude to take is this is now a buy the dip story after several years where it was a sell the rally story. So you've got to have in mind that, yes, there are always cycles in this sector, but structurally the outlook looks brighter than it has been for probably a dozen or more years.
Great. Well, Gerard, this has been terrific. Not only do our viewers get a chance to listen to your views, I got an update from you. I missed you last time you were in LA, so I hope to see you next time you make it out to the US. Thanks so much for taking the time. We really appreciate it, and best of luck to everybody in the new year.